Let's get a check of what's happening in the world of business. Our business editor, Kate Moody's here. Hi there, Kate.
Hi, Tom.
Now, the latest US inflation numbers are in, and they're going to complicate things for the Fed, aren't they? As they try to deal with the failure of not one, but two banks.
Yeah, the central bank will be holding its next policy meeting next week. The pressure is really on for it to find the right balance. Consumer prices were 0.4% higher in February than January. That's 6% higher than a year earlier on the annual scale there. It does mark the lowest level of inflation since September of 2021, but it is still 3 times the Federal Reserve's target of 2%. Now, the Fed had set the stage to continue hiking interest rates, possibly even increasing the pace from 1/4 to 0.5 percentage point, because inflation isn't going down as fast as it would like. But the collapse of Silicon Valley and signature banks will complicate that path. The rapid rise of interest rates over the last year, from near zero to almost 4.75%, was among the factors that piled pressure on SVB. It had heavy investments in government bonds, which had fallen in value because of the rate hikes. The Fed now faces a tricky balancing act between ensuring the stability of the banking sector and protecting households and businesses from spiraling prices. Well, let's speak now to Alexander Yoakum, equity research analyst at CFRA Research. Thank you for joining us on France 24 this evening. First of all, how do you think the Fed will handle this dual challenge? Will it be pushing ahead with a more aggressive rate hike next week, despite this turmoil in the banking sector?
Thank you. I appreciate you having me on. First off, I would say that I do think there was a consensus that it would be 25, even 50 basis points before this week. But given what's happened with the two bankruptcies, I do think there is a good chance it's just 25, not 50, and there's even a chance they go for zero this round. Following that, though, I do expect them to continue to raise because inflation is so high and unemployment is so low.
Now, after Monday's initial panic, Wall Street seems to be recovering. What has changed for investors?
Yeah, so I think Monday was a little bit of a fall, like a carryover from the weekend. With Silicon Valley Bank going down on Friday, I think a lot of people got really worried on Saturday and tried to go to the bank to take out their money. Then on Sunday, I think investors were looking for news that Silicon Valley Bank got acquired, and that did not happen. Instead of that, they got the news that Signature Bank also went down. So I think there was a lot of concern there. And then the headline that came out after that, talking about how uninsured deposits would be licked after, I think that got a little bit lost yesterday, so still major panic. And then today, people started to realize that their uninsured deposits, at least in those two banks, would be safe. So I think that caused a lot of the, got rid of a lot of the concern.
About 24 hours ago, we were hearing from U.S. President Joe Biden saying the U.S. banking system is safe, that customers shouldn't be worried. The ratings agency Moody's, though, has downgraded the outlook for the entire U.S. banking system from stable to negative. Are you at all concerned that this is just the beginning of a full-blown banking crisis?
I am not that concerned about a full-blown banking crisis. So there were two banks that went down, right, with Signature Bank and Silicon Valley Bank, but then also a smaller one, Silvergate Capital, which dealt in crypto. But all three of those companies were extremely niche. They were not diversified with their deposits. A majority of banking is quite diversified, especially the larger banks. And I think it's very important to point out that this is not credit quality based. If it was credit quality, I'd be a lot more worried about contagion. But since it's based off, bad securities books, it was really just a hedging issue. And then deposit outflows came from the bank run. So I don't view it as much as a full industry issue.
So not necessarily Main Street banks that we're talking about. We do understand that U.S. authorities are investigating the collapse of SVB. Do you think we might learn something that could serve as a warning to other lenders?
Yeah, I definitely think people will think twice about investing, in their securities books. Previously, that was considered quite safe. But now I think people will look at the duration more of their securities portfolios given what's happened here. I also think banks will be a little bit more careful about the diversification of their deposit base, and they'll look at, what is the insured versus uninsured amount on their deposits. These were things that people knew about but weren't necessarily top of mind before this.
All right, Alexander Yoakum, thank you so much for joining us on France 24 this evening.
Yeah, absolutely. I appreciate you having me on.
Well, as we heard there, Silicon Valley Bank, Signature Bank, and Silvergate Capital, which also closed down last week, were all lenders that focused on crypto or tech clients. The sector is in turmoil. Since the start of the year, there have been more than 128,000 job cuts in the tech industry. And on Tuesday, Meta added to them. The parent company of Facebook, Instagram, and WhatsApp confirming it would slash a further 10,000 jobs. That's in addition to 11,000 layoffs announced last year. Meta shares rising about 6% on that news. Drivers for platforms like Uber and Lyft should be considered independent contractors, not employees. That's the ruling from a court in California, a blow to labor activists who'd been lobbying for a change in how the gig economy is regulated. Catherine Viette has the details.
It's being seen as a victory for the gig economy in California. An appeals court in the state ruled that Uber, Lyft, and other app-based on-demand companies can continue to treat their workers as independent contractors and not employees. The decision on the labor measure, known as Proposition 22, was considered constitutional by the court. In a tweet, Uber welcomed the news.
Today's ruling is a victory for app-based workers and millions of Californians who voted for Prop 22. We're pleased that the court respected the will of the people and that Prop 22 will remain in place, preserving independence for drivers.
Proposition 22 was passed by California voters in November 2020 and was strongly supported by Uber and Lyft. Some drivers also backed it, but labor groups were against it, pointing out that being classified as an employee included sick days, leave, and overtime pay. The win, though, required the companies to offer workers some benefits, including health care and accident insurance. Gig economy workers are paid by the task, such as a car trip, rather than receiving a set wage. Most U.S. laws that offer employment benefits and protection don't apply for these workers, which number in the tens of millions around the world.
And Tom, of course, this is a battle that's being fought not just in California, but in cities and countries, indeed, around the world. The future of the gig economy is still very much in play here.
Okay, well, thank you very much indeed for that. Our business editor, Kate Moody. Thank you. That's it from us. I'll be back at the bottom of the hour with the top stories.